So, what I'd like to do tonight is to finish up the last chapter, and we're going to be talking about portfolio performance evaluation in Chapter 13. Chapter 15, we're just going to cut from the lineup. I will give you extra credit for if you've read the material, gone through the Smart Book on stock options. And if you want to do the homework on that, that's also another extra credit item. So I'll accept both of those. They're both up on the assignments, so you can feel free to do those if you want extra credit. And let's see. So the exam will not cover Chapter 15. It will cover 7, 8, 10, 11, 12, and 13, though. Okay. And it should look similar to what you've seen on the midterm exam in terms of there'll be a substantial number of multiple guess problems and then the matching problems, about a 50-50 split between conceptual / definitional and analytical problems on the multiple guess. In terms of study, there's also some applications like we had on for the midterm material. So look in the modules section under resources, and there are some applications that will give you more practice on working through some various problems related to the material in each of the chapters. And Tuesday of next week, we'll do our debate on Sherwin-Williams. So come prepared to discuss Sherwin-Williams and defend your recommendation. I'm assuming that most of you probably have not gotten to the point of making a recommendation yet, and that's going to happen sometime over the weekend and into Monday as you finalize your all of your material and you get it put together. Adam, did you have a question?
Yeah, are there any sample questions that we could look at for the exam? So I might not have been the only one, but I felt like the homework problems didn't necessarily prepare me the way that I wanted to. Are there any sample problems available?
I don't have any. I'm not sure that you don't think the homework reflected the
I
midterm
think it was
problems?
really close. It's just more,
Yeah.
it's really easy to go through when you have the answers, but just any of
Right.
those other ones that might be available, you know what I mean? When you know
Right.
the
Right.
answers, it's
Right.
really easy.
Yeah, I know. I took a microeconomics exam that way, and it blew my out of the water. Yeah.
Yeah.
I
Oh,
hear
that's
you.
fun, dude.
Yeah. Let me try. Do you have any chapters in particular? Because I can certainly add or create a practice. I think somebody mentioned the other night the practice problems for 15 and 16. I could create a section that has practice problems.
Yeah,
Additional practice problems, I guess, is what I would say.
yeah, I think that'd be fine. I feel like the definitional ones were fairly straightforward, but the
Yeah,
ones that like required the calculations, it was nice just to get another
sure,
repetition in.
sure. Yeah, I'll put together. Were there areas in particular that you found more difficult or problematic, or something that you'd like more
I
focus
can't
on?
remember exactly what chapter it was off the top of my head, but the one with the giant covariance formula where you had to multiply the standard deviation times all that other stuff. It just
Right,
going through
with
it was fine when you had time, but
th-
when it was like kind of off the cuff, it took a little longer.
right. So you talk. I think what that's out of chapter 12. I want to say that would be the covariance of variance of a portfolio, right?
Yes,
Where it's like x squared, x1 squared times sigma 1 squared plus x2 squared and yada yada. Okay.
yes,
Yeah,
and they
I'll
weren't terrible once you were going through them, but like
right.
the first time you saw it, it was just a big long calculation you had to keep
Right.
track of.
Right. Yeah, I'll make sure I grab some of those out of chapter 12, and then I'll just give you a kind of a sampling out of the other chapters. Let's see. I'm trying to I guess I'll post that on the final exam module section along with the formula sheet. So
That'd be great.
look for those problems there.
That'd be
So
fantastic. Dr. Allen. Thank you.
sure. Yeah, it's a good idea. Thanks, Adam. Marcus, you had a question?
So one of the challenges that I had I use Excel
Mm-hmm.
to do all of my calculations. And I mean, so when it came time to take the test, it was like, okay, I had to use a calculator, and there's just a little bit of a difference from using the Excel and the calculator.
Right.
So, is there a way that we can use Excel during the exam?
There, it, there is supposedly a way that I can give you guys access to Excel. The problem that I've run into in the past, and the reason that I didn't do it this past time, is that it doesn't seem to be something that everybody has access to. What I found was that depending upon your system, Mac versus PC, and I don't know what else it depended upon, but I had a lot of students who were not able to get into Excel and not able to do things in Excel. So I don't want to add that to it. So just assume that it's going to be a calculator at this point. Sorry, I'd like to use Excel. It's just that I want, if I do add it, I want everybody to, I want to be able to guarantee that everybody has access, and I I cannot do that in that lockdown browser. I don't know what the issue is, whether it's particular systems, maybe it's user operator error, but I had no end of problems with that. I used to do, well, I do in face to face classes, I usually have two or three big problems at the beginning of the exam that are multi part that I give partial credit on. And I had set those up, and I had given students access to Excel so that they could actually plug numbers in and do the work in Excel, and it was a nightmare. So I apologize, but I can't do that, at least at this point, in the curve up the remote technology hill, if you will. This fall, yes, because we'll be face to face, and then I can go back to paper exams. But so practice with the calculator. It won't hurt. It won't hurt you at all. The small. I'll keep the anecdote short. So in negotiating for a car many years ago, when I was still a MBA student, actually in Texas, and uh, brought in my financial calculator, and before the salesman could come up with, well, your monthly payment, yeah, I know it's going to be, $600 or $375 or something. Yeah, how did you know that? So knowing how to use that calculator, that and actually having my dog chase the dealership cat and get a bloody nose and then grab a hot dog out of a kid's hand, I got a good deal on that car. So
That sounds like quite the story.
yes, I've shorthanded that quite a bit, but anyway, so
That oddly makes a lot of sense to me. So,
all right, having that calculator can help out and be able to crunch amortized payment is helpful. So, any other questions or comments about the exam, about what we're going to do Tuesday? Rest of the BMC, if you haven't finished it, make sure that you get that done by Sunday night, the 22nd. I still only see 19 of you enrolled in the BMC class. You may have already done those sections, but I can't see it. So go and double check, make sure that you are enrolled in the class, and that way I can actually see the grades that you get on each of the sections there. All right,
Is there
so
any chance you could let us know if we're not enrolled? So I've enrolled, but I just want to make sure that
yeah,
I've done it the right way. You know what I mean?
yep, I can do that right now. In fact, I was just thinking that very thing that I should just go over there and do that. So
It's just those remaining two sections that we had correct out of the five.
That's right. Stock options and portfolio management. Yep.
Thank you so much.
Mm-hmm. Sure. All right. So let's see. Let me plug this animal in. Get out of the way. Ah, let's see. I don't want to reveal grades on here. That would be a what is it, a HIPAA violation? So let me zoom in a little bit here. I'm just going to scroll through. All right. So here is everybody that I have. Alan, April, you're in there twice. Marcus, Nathan, Brent, Alex, Jared, Adam, Adrian. And then let me go to the next page, but I need to, again, zoom in. All right. And then Claire, Anthony, Ben, Matthew, Brandon, James, Ross, Adam, and Yujing. So if you didn't see your name there, I don't have you enrolled in the class. There are only 19. I know there are, I think, 28 at this point in the class. So check that out. If you have a problem, just let me know. All right, so let me get my slide deck up here. Okay. All right, so Chapter 13 gets us to a point where we're trying to measure how well we've done as investment fund managers with our investments. This is a lot trickier than you might initially think. And the reason it's trickier is that to really do a good job of measuring performance, we really should be doing some sort of risk adjustment to whatever we're benchmarking ourselves against. And that risk adjustment is really where it becomes problematic. How do I make sure that what I'm comparing to is of a similar risk? So that when I say that I'm getting, 14% on average, and my benchmark is only getting 13%, I've got a 1% alpha. But how do I prove that that benchmark and my managed portfolio are actually of equal risk, and that 1% alpha that I'm claiming is actually due to my skill in selecting stocks that are undervalued or overweighting industries that are outperforming or underweighting industries that are underperforming, things of that nature? How do I prove that? And the answer is it's just really difficult. And not to mention the fact that as I manage my portfolio, the riskiness of that portfolio is probably changing over time. So that adds yet another level of difficulty. So oftentimes what you'll see is that fund managers will simply just compare it against a index like the S&P 500. Well, that's got a beta of about 1. And if I've got a portfolio that has a beta of 1.3, of course I should be making more money. I should be getting more returns on that because I've got a riskier portfolio. So that's not really a fair comparison either. There are a number of techniques that researchers, this is predominantly driven by researchers, but you'll also notice that the CFA Institute is trying to put together a very comprehensive means of measuring performance. So even the profession, the practitioners are trying to get involved. Obviously, CFA is actually a combination of practitioners and researchers, so there's a little of both in that group. Will Rogers, it is not the return on my investment that I'm concerned about. It is the return of my investment. Stock market will fluctuate. Yes, that is true. Okay, so performance evaluation, we're going to try to figure out, are we earning an abnormal return, and is that abnormal return that we're earning consistent, right? Because here again, remember, a realized return is just one out of a distribution. And when we measure a required rate of return or an expected return, we're taking an average out of that distribution. So if I have a expected return, a security with an expected return of 13%, There might be a 1 year where that security returns 15%, another year where it returns 8, another year where it returns 12.5 and 13.7. So that's not what I'm after, right? What I want to be able to consistently do is actually earn an average return on that security that's above that expected return of 13%. So over multiple periods, I want to be able to beat that 13% figure. We start off by looking at simply a raw return. And a raw return is just that. It's just the return. It's the naive measure too, because we haven't done any sort of risk adjustment. We haven't benchmarked it against anything. But we've got a 14% return. Okay, well, that's wonderful, but if we were in a market that was up by 22%, that's pretty lousy. If we were in a market that was down by 5%, that's really awesome. So that raw return doesn't really tell us a whole lot yet. We have to do something more with it. We've got to compare it to a benchmark or to some sort of alternative portfolio. Some of the classic measures that that go way back, Bill Sharpe, Nobel Prize winning financial economist, and most of these measures were developed back in the latter century, 70s, 80s. So he came up with a ratio that he named after himself called the Sharpe Ratio. And so here we're just notice that we're taking the excess return, right? Everybody remembers excess return is the return above and beyond the risk-free rate. This is also called the risk premium. And then he's scaling that. And by scaling, I simply mean he's dividing it by something. So this is the return, and this is the risk. So he's scaling it by sigma sub p. And sigma, of course, stands for standard deviation. So we're taking the standard deviation of the returns on that portfolio. Now, remember, we're going to talk, we'll see this when we actually do some of these computations, but standard deviation is the total risk on that particular portfolio. All right. So, and that's to be contrasted with the trainer ratio that we're going to see in just a minute. Before we get to the trainer ratio, though, let's look at a variation on the Sharpe ratio called the Sortino ratio. And basically what Sortino does is, you'll notice here, what Sortino does is focuses on this risk component. And Sortino says, and this makes a lot of sense, that not all risk is risk that we don't want. Upside risk is risk that we actually want. So why don't we, instead of measure this overall risk, this sigma, let's create a measure of risk that focuses only on that downside risk and see how things look. So what Sortino's measure does, he still has the excess return in the numerator, just like, let's see, can I get out of the way here? No, I'm right in the middle of it. Just like the Sharpe ratio. The Sharpe ratio, I don't know, can you see that? Oh yeah, Sharpe ratio is, you can just barely see it, right? Just to the right of my microphone. The Sharpe ratio is 0.39 and the Sortino ratio is 0.52, and that's entirely driven by the difference in the denominator here, where Sharpe ratio denominator, the sigma, the standard deviation of the returns over these 6 years is 0.0514. In the Sortino ratio, he only uses a couple of the years to calculate a standard deviation. What he does is he says, well, let's look at the mean, the average, that is 5%. So we're only going to focus on those returns that fell below 5%, below the mean. So here we have 2 and we have a -3. And those are we're going to calculate a standard deviation the exact same way, except that we're only going to use those two observations. So it's going to be negative 0.03 minus 0.05 squared. And then the second term is going to be 0.02 minus 0.05 squared. And that's how he arrives at this 0.0382 as the standard deviation for the portfolio. It only captures how risky is it with quote unquote bad risk, downside risk, if you will. So both of these measures are widely used. Sharpe measure is probably much more widely used than the Sortino measure, but still Sortino's ideas are interesting and helpful. Then we go on to a different denominator. Instead of looking at standard deviation of returns on our portfolio, Traynor also, I believe Traynor won the Nobel Prize, pretty sure. He was instrumental in helping develop the capital asset pricing model. Traynor said, well, instead of dividing by total risk, why don't we divide that by the only risk that gets priced, the systematic risk, the beta. So calculate the beta for the portfolio and scale our excess return or our market risk, or excuse me, our portfolio risk premium by beta. So again, all three of these measures, you've got a numerator that's returns, you've got a denominator that is risk. So it's very much like, if you'll remember to last lecture, we were talking about the security market line and the slope of that line, where we had return was our rise and run was risk. These are the same sort of ideas, right? So here we have return per unit of risk. And in this case, the unit of risk that we're talking about is beta. So whatever number we get out of the Traynor ratio is going to be for 1 beta's worth of risk, we get X%. Likewise with Sharpe, for 1 unit of sigma, 1 standard deviation, we get X% in terms of risk premium. Then yet another very popular measure, and this is, you'll hear alpha all over the place. This is Jensen's alpha, Michael Jensen, also a very well-known financial economist back from, did most of his work back in the 60s, 70s realm. Jensen's alpha is another measure of how well we're doing relative to some sort of risk adjustment. And Jensen actually specifically uses the CAPM and says, well, why don't we figure out what it is that the stock should have gotten if the CAPM is the right model, mind you. Now, what I might do to calculate a Jensen's alpha is not just to use the CAPM, but I might want to use the Fama-French 3-factor, or I might want to use the Q5 model, so that I've got a much more robust measure of the return that I should be getting. And then we could calculate an alpha that way. So instead of just having a single beta here, beta for the portfolio, I'd have beta 1, I'd have beta for the portfolio 2, and I'd have a beta 3 all in here. And in the case, if we were, say, using the Fama-French model, this would be the one of them would be the high minus the low. That's that book to market measure. That's think of it as the you can think of it as kind of the growth versus the value measure. And then the SML is the small minus the large measure. So that's the size effect. Small firms often get, well, on average, we see that small firms get much higher returns on average than large firms. So all you would do is just have, instead of just having this one term here, you would have 2 additional terms in here, plus the risk-free rate. And all of that would be subtracted from the actual return on the portfolio. And that difference would be our alpha. Okay, that difference is the extra that we're getting, the reason that somebody's willing to pay us a fairly hefty management fee to find securities to go into that portfolio that are going to achieve some sort of excess return. Of course, all of that's predicated upon the information that we discussed, was it beginning of last week or end of the week prior, about how bad portfolio managers are at actually generating alpha, at least on a consistent basis. So keep that in mind. So you can think of a Jensen's alpha as, remember, again, back to last class, we're looking at the security market line. Same framework, right? Expected return over here, beta over here. We've got this line. All securities should be falling on this line. Those securities that aren't falling on that line, like this one, security C and security A, well, we buy those securities. The security A has a positive alpha. Security C has a negative alpha. So security A is a security that we would want to buy. We want to buy positive alphas. Security C is a security that we would want to short. So if it's a negative alpha, that means it's getting less than, right? So if this thing is negative, that means that R sub P is smaller than what we should be getting. So of course, as the market adjusts to that fact, and hopefully some of our actions will actually speed that process along, then price is going to come up. So we want to, price is going to go down. So those are the stocks that we want to sell. And the stocks with the positive alpha are the stocks that we want to buy because those prices will go up. So, I don't need to really get into that in too much detail, but I think this is fairly obvious. If we run a regression, it's the intercept here, right there. That's the alpha, right? Think about the regression line. It's y is equal to alpha plus beta times x, right? And beta is the slope of this line. And alpha is the intercept to that line. And here's an example of running that regression. The real benefit out of this, not unlike when we were estimating betas, the real benefit out of this comes down here. Here we have an alpha, and it's a negative alpha, so this is one we want to short. We have a negative alpha of 1.67%. Should we short the stock? Just to make sure you can see all the numbers that might be relevant. Would you want to short this stock? Is that a p-value that I want to hang my econometrician's hat on? No, not at all. Right? I got a p-value of 0.85. That's lousy. I'm looking for something as close to zero as I can possibly find. Another way of looking at it certainly is look at a t-stat. T-stat's in excess of at least 1.68, preferably in excess of 1.96. That's the 10% and the 5% level p-value respectively. Even better yet, 2.6, I think 2.65 is a p-value equivalent to a p-value of 0.01. So, yeah, this is important to know. I mean, yeah, somebody tells me, hey, I've got an alpha 1.67%. That's awesome. But as an econometrician, I'm telling you, you don't have an alpha other than zero. Because remember, the way to interpret this p-value or this t-stat is to say that this coefficient right here, this 1.67%, is statistically not different from zero. So I can't even, as a card-carrying econometrician, I can't even say that number. All I can say is we have a zero alpha. Now, there are a lot of people who are not card-carrying econometricians who will tell you, yeah, I got a 1.67% alpha there. You bet. Not an investment I want to make. All right? So the regression has the benefit of helping us put some validity, measure the validity of some statements like that. Information ratio, that's another means of trying to assess how well we have done. And it takes this same idea. Basically, it sort of it incorporates some sort of measure of precision in here, just like we're doing when we look at a p-value. Here, what we're doing is we're taking our alpha, that 1.67, and we're scaling it by this thing we call a tracking error. So a tracking error is what I'm going to do. I've got my security here. I've got the market here. So I'm comparing it to the market. Presumably this security has similar risk to the market. Otherwise, I shouldn't be comparing it to that. I should be comparing it to something of equal or very close to similar risk. And what I'm going to do for that tracking error is I'm going to take the security returns and I'm going to subtract from those the market returns. And I'm going to get a figure. So here I've got 10% minus 8%. So I've got a 2% difference. And then negative 8 minus 12%. So minus a negative 12%. So that's going to be a positive 4% difference. A negative 4% minus 16%. So it's minus 20 and so on. I'm going to then calculate, let's see, actually we may as well finish this out, 14%, and then what is that, a minus 10% there? So I've got my differences, and then I'm just going to calculate a standard deviation on those differences. So first thing I do, of course, I've got to get a mean, and then I'm going to take the difference from each observation from the mean, square that, add them all up, and divide by n, or n minus 1 in this case because it's a sample. And I'm going to get a tracking error of 13.2%, which gives me a pretty low information ratio. And again, it's all relative, but a information ratio of 0.13 is not that great. So you're looking for a much higher value in absolute terms, right? This is a negative because the alpha is a negative. The sign of this thing doesn't really matter in particular. I could take the absolute value. What I'm looking for, though, is something that's much higher, closer to the alpha itself, the better, right? So that's yet another measure that people often use in an effort to gauge how well they're doing. And these methods, in particular, looking at the p-value, if I run a regression to get my alpha, or looking at the information ratio, these measures, those two in particular, actually give us some estimate of how good is that alpha, as opposed to just coming up with a Sharpe ratio or a trainer ratio or in Jensen's alpha. There, we've just got a number and we compare it to something else. We don't know whether that number actually is meaningful in a statistical sense. These two measures give us a little more confidence that, yes, statistically speaking, even they are or are not of value. Morningstar has a lot of great information about various measures of risk and performance of funds. So if we were to, for instance, look at this particular fund, this Fidelity Low Price Stock Fund, it's a small cap value fund. By the way, I would strongly recommend that you put this on in your bookmarks, favorite bookmarks on your browser, Morningstar.com. Even the free stuff that Morningstar provides to you is really great. So if we want, excuse me, so we could type in FLPSX for the Fidelity Low Price Stock Fund. And I'm just going to click on that to go to that information. And so here is the info about that. And I would go over here to the Performance tab. And I could look at how it's done price-wise relative to a sector or other funds of similar category, low price stocks. I can also go over to the risk tab, and here I'm going to get an alpha, right? Oops. I'm going to get an alpha, I'm going to get a beta, I'm going to get an R squared, a Sharpe ratio, and the standard deviation. Now, again, I have to take it in context. I have to take it in the context of other similar types of funds. How are we doing? Well, this is a fund we're going to buy. This actually has a -5 alpha, but compared to the rest of the category, that the rest of them have an alpha that's twice that size. So actually, since this is negative and we're going to be long this is actually a good thing. Beta, relative to the category, also less risky. R squared's quite similar. Sharpe ratio's a little bit higher, which means we're actually on a risk-adjusted basis. We seem to be getting more return out of it, and a slightly lower standard deviation. All good things. So can't recommend Morningstar enough in terms of as a resource. So here I've brought over the information on the Morningstar page. So there's the beta of that fund, -5 alpha, standard deviation mean of about 12.75%. It's a geometric return over the past 3 years. So, gives you some idea. The question that you would want to answer here is, which low price fund do I want to buy? Actually, in this case, the Fidelity fund looks pretty good on all of these measures. Now, if we were to actually calculate these, here we've got some data for a portfolio A, B, and C. We've got the market return, and we've got the risk-free rate. And so let's say that we wanted to calculate the Sharpe ratio. What would we need to do here? Well, we could take the 12% that we expect to earn on this portfolio, and we subtract from that the risk-free rate, right? So we've got our excess return, and we're going to scale that by sigma p, or 0.4. When we do that math, 0.12 minus 0.05, 0.07 divided by 0.4, I get a 0.175 for a Sharpe ratio. If I wanted to do that same thing and calculate a trainer ratio instead of using 0.4, I would use 0.5, which is the beta of this stock. So 0.07 divided by 0.05, and that gives me or divided by 0.5 rather, that gives me a trainer ratio of 0.14. Now, in isolation, I can't compare those two. That doesn't really tell me much. What I can do, though, is using each of the ratios, I can compare A, B, and C with one another. So when I do that, when I do the rest of the calculations, here's that Sharpe ratio, here's that trainer ratio. Jensen's alpha, I would take the beta right here, the 0.5 times the market risk premium, right? That's 15 minus 5% is 10%. And then I would add to that the risk-free rate, and I would subtract that from my expected return on the portfolio. So that's where they get that 2% alpha. And then we do likewise for security B and C. We could do the market. They did do the market here. So here's the Sharpe ratio on the market. Obviously, the market would have a Jensen's alpha of 0. It's not going to beat itself. So now we can say, with regard to the Sharpe ratio, if we're using the Sharpe ratio as our measure of performance, which of these securities would we prefer? Well, we want a higher Sharpe ratio. Remember, anytime we scale something by something else and we get a number, that number always has in its denominator that y. And so it's z is how many units of z per 1 unit of y are we getting here. So C gives us 0.682 per unit of sigma relative to B and A, which are considerably lower. Trainer ratio, actually, though, shows me that A is to be preferred because that's higher on a beta basis, on a single, 0.14 units of return per unit of beta. And obviously on the Jensen's alpha, I want the higher alpha with all of the caveats that we mentioned before. I really want to know truly whether that alpha is statistically significant or not. But let's assume that all of these are, then I would go for that 2.5% alpha. So each of these measures gives us a different choice of portfolios here versus A versus B versus C. How do we pick? Well, one way to think about the Sharpe ratio in particular is to focus on the denominator, the sigma sub p. That denominator is the total risk. Now, if I have a very well-diversified portfolio, the only risk in that portfolio, remember that graph that we looked at, and we said number of securities in a portfolio starting with 1, 2, and then we had 10, then we had 100, and we had this line here which represented market risk, and this asymptotically approached the horizontal, right? So sigma is this line. So if I have a very undiversified portfolio, if I only have 1 or 2 or a handful of securities in that portfolio, sigma p is capturing a fair amount of unpriced risk. So it's biasing against those sorts of portfolios or security choices. Whereas if I have a very diversified portfolio, I'm way over here, and they're basically sigma p and beta are, for all intents and purposes, the same. Because sigma p is still capturing just that priced risk. There is no unpriced risk in that portfolio anymore. So it's appropriate for evaluating an entire portfolio, the Sharpe ratio, that is. Now, when it comes to Trainer or Jensen's alpha, then we're looking at an individual security or a handful of securities that might be appropriate for inclusion in an otherwise well-diversified portfolio. So there we're picking among a variety of individual securities, which of these individual securities is providing us the best return. That could be one I might include in an already diversified portfolio. Again, some additional things I would want to do that go above and beyond what our textbook gives us is that before I actually included those, I would also want to know how they are correlated with my already well-diversified portfolio. So I'd be looking for low correlations, preferably negative, but at least something that is towards zero. If it's perfectly positively correlated, I don't care. I don't need it. I've already got my managed portfolio. I've already got my alpha built into that. So unless it's just got a phenomenal alpha, in which case I might want to overweight that one. But there again, I also want to make sure that that alpha is truly statistically significant. So those are the caveats that go along with this. I mentioned at the beginning of class about the CFA Institute, and so this is their process, this Global Investment Performance Standards. It is not just one measure; it's a whole host of process and measures that are agreed upon by the CFA and by their sponsor organizations as kind of think of it as best practices in terms of how do we measure this. And CFA Institute is very well respected by the entire financial industry. So these really are probably the best folks to do this. They also are the folks who oversee the CFA charter. So you may even work with people who have a CFA charter. That's kind of the gold standard in terms of professional qualifications especially in the investment world, but also in general in the corporate finance world too. It's highly regarded. So, CFA Institute's been working on this for a number of years. Here's the only real snag in this. Right at the moment, this is all voluntary, right? So, companies that seem to do well relative to this fairly comprehensive set of measures, they're going to want to be evaluated by that. It's also not very cheap to do it. I can calculate a Sharpe ratio or an alpha, boom, like that. This is going to require a fair amount of time and investment. So the unfortunate truth of it is that right now it's not widely used yet. I hope that changes in the very near future, because if anybody can come up with a measure or a means of measuring performance in as unbiased a way as possible and of using a multitude of approaches, I think it is the CFA Institute. So keep an eye on that. By the way, I think I mentioned this at the beginning of class, but we have some CFA scholarships to give away. There's still some available. Even if you're graduating, you can apply for it. You don't have to take the exam right now. I believe once you've been awarded that scholarship, you have up to a year to actually take the CFA exam. And you should spend the better part of that year studying for the exam. It's not an easy thing. But make sure you let me know if you happen to be interested at all in that, and I will direct you to the website that allows you to apply for that scholarship. Basically, it takes the price of the first year exam from about $1,000 down to $350. So you still have skin in the game. That's why they didn't make it zero. They don't want students to just take it and not spend any time studying. So I guess they figure $350 is enough of a skin in the game that you'll take it seriously. But please do let me know. We have scholarships every year, but if I remember correctly, we still have some left from this past year, and I'd like to award those. So basically, if you tell me you're interested in it, you will get it. So please take advantage of that. Obviously, next year we'll have more, but if you happen to be graduating soon, make sure you get it, because if you do graduate, then I can't award it to you. As long as you're still a student, I can award it to you, and you could still graduate at the end of the summer and not take the exam until next June, and you would be fine. So keep that in mind. The M-squared measure is another. This one I find quite interesting. This is actually Modigliani, Franco Modigliani, another Nobel Prize winning financial economist, from his work that he did very early in the field. He and Miller, Modigliani and Miller, they have a whole series of papers where they look at capital structure and try to understand how firms choose their particular leverage. But he teamed up with his granddaughter, Leah Modigliani, and she's also a financial professional, and they came up with this measure together, which I think is kind of cool. So the measure, when you look at it, pretty simple. What's to like about that? Well, this P star. Let's look at how we actually compute this P star. So we've got a managed portfolio, P, and let's say, for example, it has a 35% return, and we want to compare that to the market portfolio, which has a 28% return. We've calculated a standard deviation on the managed portfolio. It's slightly higher than the market portfolio. So right on the face of this, we can't say for sure whether that 35% is good or not so good, because it has a higher risk than the market itself. One other piece of information we have is that the risk-free rate is 6% over this period of time. So what we do, and this is the trick to this whole thing, is Modigliani and Modigliani said, well, why don't we create this portfolio that has 40 seconds worth of the managed portfolio and 40 seconds, or 28.6%, of T-bills. So what that's going to do, just by taking the ratio, we're just taking the ratio of the two standard deviations between the market and the managed fund, right? That's where the 30 over 42 comes from, or the 71.4%. And when we do that, the risk, and then we add to it the T-bills, so now we still have all of our money invested. We have de-risked it. We have lowered the risk of this managed portfolio from where it was to exactly equal to the market. Neat trick. So now we can compare the return on this P star portfolio, which is a combination of the managed risky portfolio with a portion of the T-bills, which is risk-free. And now we see whether we get, so now we have an adjusted return on this portfolio. We're de-risking it down to the market risk. And when we do that, we get a return on that portfolio of 26.7%. And then we compare that to the market return. And in this case, it's 28%. And oops, that says no, the managed portfolio actually was 1.3% worse than the market portfolio. So even though, the raw return, that 35%, looks good, 7% more than the market. Yeah, but when I bring the risk down and drop it down to the market level, now it's not so good. So that's the M-squared measure. This, and I don't think the M-squared is in your text, nor is this style analysis, nor is the next one after this that we're going to talk about. But I think they dropped them out of the chapter, which puzzles me. I think they added chapter 19, the pro forma financial statement chapter. So I guess they figured they had to keep the page count down or something. I don't know. Because this style analysis is really important. I think it's still quite relevant. Again, same Sharpe that came up with a Sharpe ratio, Bill Sharpe. And so what we're going to do with this style analysis is we're going to regress the fund that we're trying to analyze on indices that represent various asset classes. Or I think we should more appropriately say sub classes of assets. So we're going to do this regression. We're going to do Y regressed on. We've got beta 1, and we've got one subclass of asset returns, so that might be small cap equities. And then we've got beta 2, and we have mid cap equity returns. And we have beta 3, and we have large cap equity returns. And then we might even have beta 4, and that could be value stocks. Beta 5 could be growth stocks, and so on down the line. So basically what this style analysis does is we don't even know we don't need to know what's in this thing. In fact, many times we don't know what's in this thing because management of a fund, they only have to tell us what's in that fund every quarter. We don't know what's really in that fund in between the times that they report. They might do some what's called window dressing. In fact, that's why there's a term window dressing, because that's what they do. They make the fund look attractive to investors. They window dress it, do their filings, and then they change back to what they had before. So how do we figure out what they actually have in there? Style analysis is one way to do that. So I run this regression and I get coefficients on this beta 1, beta 2, beta 3. The way we term that is we look at the coefficients that load. And by load, what I mean, they have a beta coefficient that is significantly different from 0. And that essentially helps us to understand what sort of securities are more than likely in this particular fund, this fund Y. Because let's look at some data here. So here we've run 1, 2, 3, 4, 5, 6, 7 different factors. We've regressed our fund on these 7 different factors: T-bill, small cap, mid cap, large cap, high PE, low PE, and medium PE. The only 3 betas that loaded were the mid cap, the large cap, and the high PE. So basically what we can say is that this fund, whatever it is, we don't even need to know what it is, but a little under 2/3 of it behaves just like a large cap fund. And about 1/3 of it behaves just like a medium cap fund. And whatever's left over looks like the returns of a high PE, a growth fund. Okay, so this is kind of reverse engineering, if you will. What's in this series of returns? So we're basically decomposing that series of returns, or that return in this portfolio that we're trying to analyze, and regressing it on these other factors helps us to determine what are the returns in that fund most like. All right. So again, a really valuable form of analysis. And then this performance attribution is, again, something that the authors decided to drop out of this edition of the textbook, out of that chapter. But I've kept it in the slide deck because here again, I think it's a very important means of trying to understand where a particular manager does well and where they don't do so well. So here we're looking at allocation choices, and that is allocation within particular broad asset classes. And there we're actually looking at, do we underweight or overweight in a particular asset class? So let's compare equities to bonds to commodities. And whatever the percentage on market cap is of those things, that would be neutral weighting. If I overweighted, I would be putting more than that percentage into one of these asset classes. If I underweighted, I'd be putting less than that into that. And obviously, I'd be doing the opposite in one of the other asset classes. I do that because as an analyst and a fund manager, I think that particular asset class is going to do better this year than the other asset classes. Then I also make some choices in terms of industry and sector choices within those asset classes. So I'm kind of subdividing those asset classes. And then finally, within each of those subdivisions, I may be picking particular securities. So instead of just buying specialty chemicals as a whole, I might pick Sherwin-Williams in particular in specialty chemicals. Okay. Then I compare that to a benchmark or what's called a bogey portfolio. And I want to select that benchmark or bogey portfolio for each of the asset classes. I know what the neutral weighting is for that bogey. And the bogey has all of the securities in it. And then I calculate the return on the bogey and on the managed portfolio and explain the difference in returns based on component weights or security selection. I'm not going to go into the details of how that's done necessarily, but I think this picture actually describes it quite nicely. So here we have the return on the bogey, and here we have on this axis, we have the weights. So in this particular case, the manager has overweighted for that particular asset class, and that overweight has contributed to their excess return, their abnormal performance by this amount right there. And then it was selection within that asset class that contributed an additional amount to their portfolio return, which is an abnormal return. So basically what I'm doing is I'm able to separate out in this performance attribution. Is it because of asset allocation and sector, subsector, and industry selections where I overweight or underweight based upon my expectations for that particular sector or subsector or industry? Or is it because of a particular security that I select within that industry? And so, for example, we see here it broken down into basis points. So the contribution based upon overweighting or underweighting, say, equities versus bonds versus commodities, gave us 31 basis points. Sector overweight or underweight gave us another 129 basis points, or 1.29%. And then security selection gave us 18 basis points. And then in terms of, we also had fixed incomes apparently in here. So that gave us an additional 3.1. And that adds up to the abnormal return. You can think of this like an alpha of just a little over 1 1/3%, 137 basis points. So all of these methods and measures have some validity and are helpful. Many managers will do this attribution, performance attribution, just to show to their customers, hey, I'm really good at security selection. So this person isn't so good at it. Most people aren't that great at it. But if you are able to pick which to overweight, which sector, subsector, or industry to overweight or underweight, that's where you can really make quite a bit of a killing there. That's where the bulk of this abnormal performance came from. Questions so far? All right. Let's see. This is the kind of the wrapping up the chapter here. This is more about ongoing management of the portfolio and assessing the level of risk that we're exposed to as fund managers, really. This could be anybody. This could even be an investor saying, how much could I lose in a particular period of time? A day, a week, a month? And one of the means that we use to do that is this thing called value at risk, or VAR, not to be confused with vector autoregression. Vector autoregression is a statistical technique that econometricians use. This VAR stands for value at risk. And they do usually denote the difference by using a small a instead of, if you're talking about vector autoregression, you'd write it this way. But just make sure when you're talking to a financial economist, especially a quant, make sure that you're clear because the quant may not know whether you're talking about value at risk or vector autoregression. All right, so value at risk is a technique for assessing our risk. And what we're going to do is we're going to state a probability of at least a particular loss or more. And therein lies both the relevance and the importance of this measure and the weakness of this measure. The importance of it is that over a particular time period, I can say, hey, there's a 17% chance that we will have an 8% loss on the portfolio over the next year. That's useful information to know. That also means that there's an 83% chance that we will have a return that is greater than minus 8%. The weakness of it is that we're only looking at that least bad outcome, right? There's a 17% chance that it's at least negative 8%. That means that there's 17% chance that it's even worse. Oh, doggone it. I'm reversed on your screens. I want this to go to the left. Is that going to the left on your screens? Or is mine reversed here? Anyway, you'll get it is. This way is going to the left? Okay.
Yep.
All right. I wasn't sure whether what I was viewing was reversed and you were seeing the same thing. So what I'm worried about is here's 17%, or here's my negative 8% return. But then to the left of that is negative 9, negative 10, 15, 20, 30, or worse. So that's also the weakness of VAR. There are some more sophisticated techniques that attempt to add up all of that and give you even a dollar figure about what could you possibly lose in a particular time period. But VAR is pretty popular because it puts it down to a single number, and CEOs like to see single numbers for some reason. Oh, okay, I can live with 8% loss. It all depends upon a standard normal distribution like this, where we've got some sort of average, and then we're one standard deviation to the left, two standard deviations to the left, and so on down the line, 3 standard deviations to the left. And if you don't remember, one standard deviation either side of the mean is about 68% of the entire distribution under this curve. 2 standard deviations encompasses just a little over 95%, and 3 standard deviations is 99 and almost 3/4%. So let's take as an example, suppose you've got the S&P 500 index fund, and you want to know what is the probability of at least getting an 8% loss in any particular 1-year period. So if we were to look at the historical record, and here again is another of the weaknesses, right? We're looking at the historical record. that doesn't necessarily mean that's what's going to happen in the future. And we find that there's a 12% average return, and a standard deviation on that is 20%. So one standard deviation to the left of the mean is 8%. Now, let's see, we had what, 68% between those two? So that means that we've got about a third out there in the tails, a 1/6 in one tail and a 1/6 in the other tail. We only care about the left-hand tail. It's the one that worries us. So this is that 2/3. They're rounding considerably. So we've got a 2/3 chance that it's going to fall between one standard deviation above and one standard deviation below, or -8 and positive 32%. And obviously I said that the wrong way. I should have reversed it so that I could have said respectively. So the 32 obviously is one standard deviation above, and the -8 is one standard deviation below. Now, how do we get the tail? Well, we know that there's 1/3 in the two tails, so only 1/6 in the left-hand tail, and that means about a 17% chance over the course of the next year that we suffer at least an 8% loss. And like I say, that when you look at a distribution like this, we're right here. That's -8, that's 12, and that's 32. All of that mess. So actually this would be what, -28? This would be -48. There's a pretty sizable probability that that could be a loss too, right? So that's why when I say that boiling it down to a single number, like -8% chance, or -8% with a 17% chance this next year, executives that aren't finance people or don't understand finance, they hear -8, 17% chance and go, oh, I can live with that. Well, what they fail to recognize is that that includes a fairly substantial chance of -28 and a not inconsequential chance of -48 too. So, by the way, boss, you might lose a quarter of your portfolio or half of it too. And I can calculate those probabilities as well. But you asked me for one number, and I gave it to you. Don't be that person, right? You don't want to get fired when the return on your fund is -20, and your boss goes, "I thought you told me it couldn't be less than -8." Right? So be careful with that sort of thing. I think that is about it for this chapter. We're at about 7:47, I guess. Questions on this material? Okay. I forget who it was who asked whether we'd have time to work with the teams, but so we are basically done with lecture as far as that goes. So unless you have other questions, I'll stick around. If you all have questions about your individual projects, we can go off into a breakout room if you want. Or you can work with your teams. I could set up breakout rooms, but you all have access to Zoom anyway, so you could set up even your own Zoom sessions if you want to keep working on that and kind of finalize at least that second deliverable. Let me just, of course, since there are no questions, and but I still don't want to stop talking at this point. Let me just remind you that third deliverable is also quite important. It also has the largest number of points available to you. So let's just go take a quick peek at that. And let me just walk through a couple of these items because I'm sure that there will be questions about that. All right, so remember, item 2 on here, you're going to get that off of Bloomberg if you haven't already. Go to function EQRP, Equity Risk Premium. And so you don't have to do item 2. You still do need to calculate a growth rate and give me those 4 factors and write a paragraph on each factor. One could be macroeconomic related, but most of them should be either industry or specific to Sherwin-Williams. What's management doing? What does management say they're going to grow revenue and earnings over the next couple of years by? What do they say? How do they plan to do that? Do you think that's achievable? And if you do, you might say, okay, we're adding an extra couple of percent to the historic average because management says that they're going to grow at that rate by doing X, Y, and Z. Another factor could be related to the industry growth. What's that industry forecast say is going to happen over the next few years? If I think that's reasonable as an analyst and I rely upon it, I could say there's another factor. I don't have to agree to all of it either. You could certainly say, hey, we think, an extra 3% on sales is a little ambitious, but we're pretty sure they'll be able to at least get 2%. And remember, that's you as an analyst bringing your subjective expertise to this question. That's why we actually read your reports. That's why we listen to you. You're bringing, I can dial up management or look at the 10K or listen to the analyst call and hear them all day long, but we know that they're cheerleaders for the company. I want that more unbiased, independent opinion from you all. So that's the 4 factors. You're going to have to do some writing on that. This is the number 2 is off EQRP. Residual income model, you can either do that or you can do the DDM, the dividend discount model, since Sherwin-Williams pays a dividend. You might want to use the 2-stage. If you do use the residual income model and want to do it as a 2-stage, I've got the formula down there in the other resources here in this module for the security analysis. And then the relative valuation, again, from another perspective, right? You're going to get that PE from your, presumably a forward-looking PE from Bloomberg, and that's for your comparables. You can take an average, and if you don't like some of the comparables as well as the others, if you don't think they're as relevant or as good a comparable for Sherwin-Williams, underweight that. You don't have to do an equally weighted average. And use those comparable averages and multiply the EPS for Sherwin-Williams from last year, then multiply that by 1 plus your growth rate estimate that you got up here in item 1. And that's going to give you your relative valuation on a per share basis. And then, of course, this discounted cash flow analysis, that all comes straight out of your pro forma. These first 2, the RIM or DDM, and then the relative valuation, those are what I call back of the envelope estimates of value. You got to do them. They're important that you know what those numbers look like, but are those the numbers that I want to put my $1 million investment on? Not necessarily. This discounted cash flow is a much more robust method, even though the version of it that we are doing here is still not quite as detailed as what an analyst would do. They would have an even more robust spreadsheet and pro forma that is much more detailed and incorporates those growth rate assumptions in a much more detailed fashion. kind of item by item almost, if you will. But that discounted cash flow analysis, you're going to get the cash flows. You got that terminal value out at the end of 2025. You're going to discount all of those back to today at your cost of capital, your K, and then add those up. That's going to be an aggregate value. In order to put it on a per share basis, you'll still need to divide that by the number of shares of stock outstanding to get a price per share. And then you've got three estimates of value. You've got your residual income model, or DDM, or both if you want. You've got your relative valuation, and then you've got your discounted cash flow valuation. Those may or may not agree with one another, and those may or may not agree with the market price. And it's up to you as to how much confidence do I have in all of these measures? Do I think that one is a better estimate than another? If so, why? And that should influence you significantly in terms of making your recommendation buy, sell, or hold. There's still a very soft piece to this. And before I get to that, let me just not forget to mention sensitivity analysis too. So in all three of these models, we have two primary inputs that are estimated with significant error. One is K and the other is G. So what you should do is at a minimum, figure up a worst case K, which would be a high K, and a worst case G, which actually would be a low G. Calculate all these values on those bases, and then do the reverse. A worst case G would be or a best case G would be a high G relative to your base case, and a best case K would be a low K. And then recalculate the numbers. So you're really going to have three numbers, a base number, and then a high and a low range. And ideally, you're hoping that the actual price 1 year from today or thereabouts, falls somewhere within that range. And then the third deliverable is equally important, and this is where you're going to finalize your decisions about, is this a buy, hold, or sell? And given that we're looking at a company and we're not actually having to put our jobs and our our reputation on this, you might still say, you know what? I don't think any of these models are really true representations of the value of Sherwin-Williams. So you could do that. I wouldn't say that that's something that you would want to often do, but because we're using two back of the envelope methods, and then we're kind of using a very rough measure of the discounted cash flow analysis, I still wouldn't be completely opposed to you saying, you know what, we don't have confidence in any of these, and go with some other version of your valuation. And that would have to, though, be dependent upon something up here, one of either the investment catalysts or the value drivers. And if you're not sure what those are hot links. You can click on that, do some reading on what those words actually mean. So these three things you're going to want to write at least a paragraph or two on this. This is really getting what you're trying to tell me as a potential investor in Sherwin-Williams is, why should I believe anything in this report? What is it that you as an analyst think really matters? The critical assumptions here, those are the things that you're estimating with error. The G, the K, the valuation estimates that you came up with. What assumptions are you making that if you're wrong, it's going to have a very significant impact on your recommendation? So if I think that the growth rate is going to be 10%, and if it turns out that it's actually only 3%, I go from a buy to a sell. That's a critical assumption, right? I've assumed 10%, but if it's really only 3, and there's a chance that it could be 3, that's pretty important that I, as the investor, know this. I want to know where are the weaknesses? What are the Achilles heels in your analysis? You need to, and as a researcher, we all do that when we write research papers. We basically have to tell the reader what is it that is, what is it that might mess up these results. We're telling you a story. Here's the story I want you to believe, but here's the reason that you might not believe this story. Here are the weaknesses. These are the Achilles heels. That's the critical assumption. And then the investment catalysts and the value drivers, so the critical assumptions are something that you, as the analyst, assume. The investment catalysts and value drivers are related to the company. All right. So that's the Sherwin-Williams piece of it. What is it that makes Sherwin-Williams worth the current share price? All right. And it's one or both of these. And again, you can click on this link and it'll take you what is a investment catalyst. A catalyst is an event or other news that propels the price of a security dramatically up or down. So what is it that may do this to Sherwin-Williams in the near future, one way or the other? Or maybe there isn't anything. Maybe you've got just critical assumptions and value drivers. And again, click on the link for the value driver. Value driver is an activity or capability. Where did you go? Come on, go away. I am trying to scroll down. There we go. A capability that adds worth to a product, service, or brand. So what's unique about Sherwin-Williams relative to the comparables that gives it value uniquely to itself as opposed to any of the comparables that you're looking at? So there you're going to be wanting to write a paragraph on, wrong thing. You're going to be wanting to write at least a paragraph, preferably 2, about 4 of these things. You can choose, from these 3 categories, but I want you to have 4 different elements there that you're going to type. Maybe 2 critical assumptions, maybe an investment catalyst and a value driver, or 2 value drivers and an investment catalyst and a critical assumption. That doesn't matter to me. What does matter is that these are the most important things that you want me, as the investor, the dentist from Des Moines, the classic uninformed investor, as I'm reading this, you want me to know about this. This is why I should be investing in this stock, and these are the things I should be concerned about. Pros and cons of holding the stock. Why should I hold Sherwin-Williams rather than AkzoNobel? I want specialty chemicals. Why is it Sherwin-Williams? Pros and cons. So those are different than these top 3 things. So again, you're talking to me, the dentist from Des Moines. And then the final deliverable is really putting it all together, organize it, do a table of contents, make it so that I don't have to dig to find something, because if I don't find it and you don't get points for that, so make it as convenient for me to find things, spend a little bit of time on neatening things up, making it look like a professional report. And so I've listed everything that I want you to have in there in particular, and that is pretty much it. Obviously, you are going to need to come up with one of these recommendations. And as I say here, since you're not beholden to an investment bank, since your job does not depend upon your recommendation, and many analysts, their jobs do depend upon a recommendation. So what's happened to these recommendations is that they have been compressed. So typically, we rarely see a sell, and we almost never see a strong sell. We see a fair number of buys, a fair number of holds, and a fair number of strong buys. But rarely do we see those other 2 categories. Why? Pretty simple. Many stocks should be sells. But if I work for an investment bank, and even though I have this paper wall between me and the investment bankers who work on the corporate side and sell our products to these same companies that I'm analyzing, even though there's this paper wall and I can't talk to those people legally, there's still, some potential for bias. You guys don't have that potential. You can, if you think it's a sell, it's a sell. Don't worry about it. As long as you justify it in your discussion, I'm fine with a sell. All right. Now I'm done talking. Any questions that have arisen from that discussion?
Can you go back over the relative valuation a little bit? Just because.
Sure.
I don't know. I felt like it was a little bit fast when you first explained it.
Sure. And here you can go, you can go back to chapter 6. Relative valuation, the computation is quite simple. Let me go over to, I've got a blackboard here, so I'll just go back to the slide deck. So we've got our comparables. And I've got forward-looking PEs for those guys. So that is a PE using the current price and an estimate of future earnings. That's a forward-looking PE. And so I might have, let me just make the numbers simple. Let's say I've got 30, I've got 20, and I've got 10. And actually, you guys have 4 comparables, but so I've got, add that up, and I've got 60, divide that by 3. I'm going to equal weight these guys because I think these 3 comparables are all equally valuable and relatively close to Sherwin-Williams. And so I'm going to come up with a average PE, forward-looking PE for my comparables of 20. Then I'm going to come over to Sherwin-Williams, and I'm going to look at their current EPS. So I'll call that EPS 0. I don't know. Anybody know off the top of your heads what's the most recent trailing 12 months EPS on a per share, earnings per share? Let me just make up a number then. Go ahead. 7.48. Thank you, Yijing. So $7.48 per share EPS. And so then I've also got a growth rate for Sherwin-Williams. And let's make that 10%. I'm not trying to tell you what anything ought to be. I'm just making these things up totally. So then I will just take my average PE, forward-looking PE, times my EPS, times 1 plus my growth rate, and I get $164.56 per share. That's why I say something like this is back of the envelope, because I can do that on the back of an envelope if I have some of these numbers laying around and quickly come up with a number. Does that make it good or bad? Well, that depends on, oops, you can't see that. Let me get out of the way here. There we go. Sometimes there's value in simplicity. And the one thing that this does that the DCF doesn't do as well, and the DDM and the RIM don't do at all, and that is it incorporates some sort of current market trend into this, because I'm looking at the current PE and it's forward looking for my comparables. So that's what the market is actually valuing my comparables at right now. And so that piece of it is quite valuable to me. And that comes into play. Let's say the market is overheated. And there are some people who argue that at 35,000, yeah, it's a little rich. But this brings that into this formula directly and lets us look at a price per share based upon that relative valuation. The other methods, the other two, either the RIM or the DDM, is another back of the envelope, or the DCF, which is a much more complicated, more robust method. Those are both fundamental analyses that don't really take into account directly, anyway, whether the market is overheated or a little bit undervalued, whereas this does. So, does that help, Ellen?
That helps a lot, yes.
Okay. Very good. Anything else that's come up as I've gone through these? All right. Well, I will turn it over to you all. It's 8:10. I'm going to stick around. If anybody has, individual questions, we can jump into a breakout room if you don't want other teams hearing it, or we can just talk either way. So, and remember, tomorrow, at least through, I'd say, mid-afternoon, I'm going to be otherwise occupied. So after that, there's a good chance I should be able to do a Zoom session. And I'll certainly try to answer your emails even earlier if possible. But definitely by, late afternoon, I should be able to get to emails as well if you have questions that come up. All right.
Can I ask one last question?
Oh, yeah, sure, Alan. Go ahead.
So I know this is one of these weird things because there's not one right answer because
Mhm.
it kind of depends on what you decide on for your growth rate and different factors. But I guess are you just kind of looking for like that we understand the concept and we're trying to interpret our numbers correctly, or how strictly is this graded?
Um,
Or is that a bad question? It might be a bad
well, no, I think that's a very reasonable question. I want to see process. I definitely want to see process. Process is very important in this exercise. The numbers you come up with, those are your numbers. And as long as you justify where you got them and why you think the growth rate is X and somebody else thinks it's Y and I think it's yet another variable, as long as you've got some rationale for it that you can point back to the company, you can point back to the industry forecast or the macroeconomic forecast or some combination thereof and say, here's where I came up with this. I can't argue with that. We look at analysts, dozens of analysts following various companies, and they come up with slightly different recommendations. There is kind of a herding effect. You guys don't have to herd. You can go out there and kind of be your own group and your own analyst. And if you think that, there's going to be a problem, say so. And tell me why you think that's the case. So, yeah, it's more based on process. And did you do all of the activities that I've asked you to do? Did you do the write-ups on the 4 factors for growth? Did you talk about your critical assumptions, your investment catalysts, and investment catalysts and value drivers and that sort of thing? Let me also give you just a brief example. And I don't think I've mentioned this in the past. Forgive me if I have. I usually say something about this particular anecdote in every class I've taught ever since the Y2K occurred, because this actually dates back to the Y2K incident. So many of you were a wee bit too young to remember Y2K. But what happened back in the late 90s was that the computers that we all had at that time, RAM was extremely dear. And so what they did was to save RAM and to save storage space, instead of stating a year as 4 digits, they only used 2, right? So, starting in the 50s, it was pretty easy. You could go out 40 years, and you wouldn't have to worry about it. So there were no mortgages that went out past 40 years. Everything was within that range. So 2-digit years were just fine and dandy. Trouble is we come to we come to the year 2000, and all of a sudden 2-digit years are a real big deal. And all of a sudden we realize we've got a whole bunch of code out there that's written with 2-digit years. And we don't even know where some of that code is. It's buried in there, and it's requiring us to go through millions of lines of code to figure out where is it, so that the world doesn't come to a screeching halt. Believe me, there was fear that the electricity would shut off, the water systems would shut down, and we'd be all out there, with bow and arrows hunting rabbits and, fending for ourselves in the wilds of Shaker Heights and Cleveland Heights. So IBM was doing a land office business because of this. And the analysts that followed IBM we're all talking to IBM, and IBM's going, oh, God, our profits are going to be through the roof. And it's going to go on for years and years and years and years. There's one analyst, and I got to go back and find the guy's name because I need to attribute this to him. But he said, you know what? I'm a little skeptical of you, IBM. And he went out and he actually started calling some of IBM's customers. And every single customer that he called, the customer said, he said, well, so what do you expect to spend in 2001 after this Y2K? Obviously, hopefully we all get through this. But once we get through it, what's your budget for 2001 and 2002? And the answer was, we blew that budget last year, getting ready for Y2K. We have no budget. We're not going to do anything in 2001 for sure. And we're barely going to do anything in 2002. And he got that over and over and over again, to the point where he finally said, hey, all of you other analysts, you other 30 or 40 really smart analysts, you're wrong. You all have strong buys or buys on this. I got to sell. He went out on a limb. Turns out, of course, luckily he was right. Otherwise, he'd be out of a job, right? And he got written up in the Wall Street Journal, and the rest is history. And of course, nobody did have any money left to spend, so IBM didn't do as well as they thought they would do. So the moral of that story, and the relevance of it to your question, Alan, in particular, is that, hey, go ahead. If you find some data that nobody else has about Sherwin-Williams, that is awesome. I mean, that's what Warren Buffett does. He looks for the stuff that nobody else sees. So I like to encourage people to go out there and kind of dig around and go against the herd. So hopefully that helps.
Yeah, fair enough. I guess I'll try to think outside the box.
Right. I hate to use that old that gets so old and used, but yeah, think outside the box.
All right. Well, thank you.
Sure, you're welcome. All right. Unless there's anybody else who's got questions, I'll stick around for, if everybody logs off and goes to your team rooms, that's fine. I'll still be around if you want to email or jump back in here. But if everybody is gone, I may go grab a little dinner too. So email me if you do want to chat later on. I'm still available, of course.
Thank you.
Thanks. Have a good night.